welcome back to Verve Accounting. I'm thrilled you're here today because we're diving into one of the most important financial documents for your business, the income statement. Now, I know that looking at all those numbers can feel overwhelming, but don't worry. By the end of this video, you'll know exactly how to read income statements and use the information to make smarter decisions for your business. So grab a cup of tea or coffee, sit back, and let's get started. What exactly is an income statement? Sometimes called a profit and loss statement, P&L, the income statement shows how much money your business made, revenue, and how much it spent, expenses, over a specific period like a month, a quarter, or a year. Think of it like a report card for your business. It tells you if your business is making money, a profit, or losing money, a loss. It's one of the most important financial documents because it helps you see how well your business is performing and where you might need to make changes. Why should you, as a business owner, care about your income statement? Here are 3 reasons. 1, the income statement helps you to make informed decisions. Your income statement helps you understand your business's financial health. By knowing where your money is coming from and where it is going, you can make smarter decisions about things like pricing, cutting costs, or investing in new opportunities. 2, it helps you track performance over time. The income statement allows you to compare your business's performance over different periods. For example, you can see if you're making more profit this year as compared to last year, or if certain expenses have increased or decreased. 3, the income statement helps you to prepare for taxes and loans. The Canada Revenue Agency requires accurate financial reporting for tax purposes. Plus, if you need a loan or want to attract investors, they'll want to see your income statement to understand how profitable your business is. Now that we understand the importance, let's dive into the different parts of the income statement. An income statement is typically divided into several key sections. Let's break them down one by one. Revenue or sales. This is the total amount of money your business earns from selling its products or offering its services before any expense is deducted. Think of it as the top line. For example, if you own a bakery, your revenue includes all the money you make from selling cakes, cookies, and other pastries. Costs of goods sold. These are the direct costs associated with making your products or offering your services. For a bakery, the cost of goods sold will include things like eggs, flour, sugar, and any other ingredients that goes directly into making the baked goods. Subtracting your cost of goods sold from your revenue gives you your gross profit. Gross profit is your revenue minus your cost of goods sold. It tells you how much money you're making from your core operations before any other expenses are deducted. If you sell a cake for $20 and the cost of the ingredients and everything it took you to make that cake was $8, your gross profit is $12. Operating expenses. These are the costs of running your business that are not directly related to making the product or offering the service. They include things like rent, utilities, salaries, marketing, and office supplies. These are sometimes called selling, general, and administrative expenses. Operating income. This is what you get when you subtract your operating expenses from your gross profit. It is also known as your operating profit, or EBIT, earnings before interest and tax. This tells you the money your business made from running its regular operations before paying interests and taxes. Other income and expenses. This section includes any income or expenses not directly related to your main business activity, such as interest earned on bank accounts or gains and losses from selling business assets. Net income. This is the bottom line, your total profit or loss after all expenses, including interests and taxes, have been deducted from your revenue. If the number is positive, congrats, your business is profitable. If the number is negative, then it's time to take a closer look at where you can make changes. Now let's break this down with a practical example to make it even clearer. Let's walk through an example of a simple income statement for a small business. Let's say a coffee shop called Java Joy. Here's what their income statement might look like for the month of August. Revenue. Java Joy made $10,000 in sales from coffee, pastries, and sandwiches. Cost of goods sold. The direct costs for coffee beans, milk, sugar, and other ingredients for the sandwiches came to about $3,000. Gross profit. What is the gross profit for Java Joy? The revenue of $10,000 minus the cost of goods sold of $3,000. Java Joy made a gross profit of $7,000. Operating expenses. Java Joy's operating expenses for the month totaled $4,500. It included rent, utilities, wages, marketing, and office supplies. What is Java Joy's operating income? A gross profit of $7,000 minus the operating expenses of $4,500 equals a total of $2,500 in operating income. Other income and expenses. Java Joy earned $50 in interest from its savings account and had a one-time equipment-related repair for $100. Java Joy's net income would be the operating income of $2,500 plus the interest earned of $50 minus the repair expense of $100. So Java Joy had a net income of $2,450 for the month of August. This tells the owner that overall the business is profitable, but there might be room to improve profits by lowering costs or boosting sales. By breaking down each step, you're able to see how much money is flowing into and out of your business. Now let's move on to some tips for analyzing your income statement. Here are some tips to help you get the best out of your income statement. 1. Compare periods. Look at your income statement over multiple periods like months or quarters to spot trends. Are your sales increasing? Are your expenses going up or down? Which expense is going up or down? This will help you understand your business's performance over time. 2. Check your gross profit margin. Your gross profit margin is the gross profit divided by the revenue. This shows how efficiently you're producing your goods or services. A higher margin means you're keeping more money from each sale. If it's low, consider ways of reducing your cost of goods sold or increasing your prices. Number 3, monitor your operating expenses. Keep an eye on your operating expenses to see if they're growing faster or at the same pace with your sales. If they are, it might be time to cut back and find more cost-effective ways to operate. Number 4, focus on net income. While it is important for you to understand all aspects of your income statement, your net profit ultimately tells you if your business is profitable. If it's not where you want it to be, dig deeper to find areas to improve. Let's discuss how you can use the insights from your income statement to make better business decisions. Your income statement is a powerful tool for making informed business decisions. Here is how you can use it. Adjusting pricing or sales strategies. If your revenue is not where you need it to be, consider adjusting your pricing strategy or offering more promotions to boost sales. For example, if Java Joy notices a drop in coffee sales, they might introduce a loyalty program to encourage repeat purchases. 2. You can use your income statement to control costs. Look for ways to reduce your cost of goods sold or operating expenses. Could you negotiate for better rates with your suppliers? Can you find a more cost-effective way to market your business? Small changes can add up to really big savings. 3. Plan for growth. Use your income statement to recognize areas for investment. If you have a healthy gross profit but high operating expenses, consider investing in equipment or technology that would make your operations more efficient and reduce those costs in the long term. 4. Your income statement can help you set realistic goals. Use your income statement to set measurable financial goals. For example, aim to increase your net income by 10% over the quarter. Having clear goals will help you stay focused and motivated. Now, let's move on to some common mistakes to avoid when reading your income statement. Here are some common mistakes small business owners make when reading their income statements and how to avoid them. 1. Ignoring trends. Don't just look at the numbers for one period. Compare them over time to spot trends and understand the bigger picture. 2. Not understanding the difference between gross and net income. Gross profit and net income are different. Make sure you understand what each one represents and how they impact your business. 3. Overlooking operating expenses. Don't ignore your operating expenses, even if your gross profit looks good. High operating expenses can eat into your profit quickly. 4. Failing to act on insights. Your income statement is only valuable if you use it. Take action based on what the numbers are telling you. Now, let's talk about how Verve Accounting can help you make sense of your income statement and grow your business. At Verve Accounting, we specialize in helping small business owners like you understand your financial statements. If you find income statements confusing or need help analyzing your numbers, here's how we can help. Personalized financial analysis. We provide customized reports and explain your financial statements in simple, easy to understand language. We help you see what's working well and where there is room for improvement. 2. Strategic planning. We help you use your income statement to create strategic growth plans, set achievable financial goals, and identify cost-saving opportunities. 3. Tax preparation and compliance. We ensure your financial records are accurate and compliant with all tax laws, helping you avoid penalties from the Canada Revenue Agency. If you're ready to take control of your finances and make informed financial decisions, reach out to us. We're here to help you every step of the way. Remember, your income statement is more than just numbers on a page. It's a roadmap for your business's success. By understanding how to read and use it, you're giving yourself the tools to grow with confidence, make smarter decisions, and stay on top of your finances. Thank you so much for tuning in today. If you found this helpful, please like this video and subscribe to Verve Accounting for more tips to help your business thrive. You've got this. Happy accounting. Until next time, keep going and keep growing. Remember, every successful business starts with the basics. Take care and see you soon.